Today, we're going to be talking about the different asset classes within commercial real estate. We're going to go through it soup to nuts. And then we're going to give you a ranking system, kind of that hot, crazy scale that you can work off of to decide what makes best sense for you as a new investor. I think they're going to like it.
I do too.
You know, as we've talked before, there are so many different asset classes within commercial real estate. And one of the biggest questions I always get is, Scott, where should I start?
Yeah, what even is commercial real estate? You know,
right?
It sounds nebulous.
It's very vexing, and it's also something that's intimidating.
Sure.
A lot of people are intimidated because they probably can't even spell commercial. Right? I've seen plenty of people. Yeah, I've seen plenty of people myrtleize that word, just trying to get it out of their mouths, let alone actually trying to spell it.
Yep.
And then when you start to understand the differentiation in the models, what we always tell people is, look, let's start easy early.
Yes.
Right? Easy early. And so one of the asset classes that I've always utilized as kind of a shoving off point for folks is multifamily. And multifamily can be apartments, it can be mobile home parks, it can be student housing, it can be assisted care facilities, it can just be vacant land that you got pad sites on.
Sure.
It allows multiple tenants operating under one quote unquote set of rules with some common areas, right?
It's got beds.
It's got beds, it's got tenants, it's got, sometimes it's got infrastructure. If it's a mobile home park and you're not leasing the actual units themselves, then it won't even have any infrastructure. So it won't even have beds. It'll just have utility hookups. But what we love about this is that most people have had some familiarity with a standard apartment lease. And it really is very analogous to residential real estate, which a lot of people find, while it can be very complex,
sure,
no doubt, they find that to be familiar, right?
Yep.
They've lived in these types of environments. They understand that they're dealing with a basic type of lease. They understand that they pay one fixed fee to pay for their monthly tenancy. They know that their expenses typically don't fluctuate and that their good lease is good for usually 1 year. It's usually an annual lease. And so those types of things make it just easier for people to understand. If you get it wrong year one, you can kind of reset the game year two when that lease burns off.
That's right.
Whereas in pure commercial, when you talk about office and retail and industrial and land development, those leases tend to be much longer, 5, 10, 15, 20, sometimes 40, 50 years long.
Yep.
And so in those types of things, you get it wrong in the first draft.
It propagates forever.
You're stuck with it.
So I came up with a really easy ranking system here that I think that we could use for everyone out there listening to this, right? And it's 3 aspects. So I'm going to want you to rank each of the asset classes in these 3 categories, 1 to 10.
Hot, crazy?
It's the hot, crazy scale.
Okay.
So profitability potential.
Yep.
The risk.
That's crazy.
That's crazy. And then the competition.
Crazy.
Right. Okay. So let's start with multifamily. Let's talk about the profitability matrix on that.
Well, I love it.
1 to 10. Explain your answer first.
So what I love about the profitability that's associated with multifamily assets is that it's a commodity.
Sure.
So you're not really struggling to find the user or the tenant, right? Everybody needs shelter. It's a basic human need. It's like clothing and food. If you don't have it, you're not living.
Yep.
So the idea is you don't have to find that unicorn, that needle in a haystack. What you have to do is you have to compete. And competing is about offering the right product to the right tenant with the right pricing. It's very simple. You can't give somebody, gold leaf and concierge services and butlers and, drivers and drop-offs if it's low income. It's just not something that they demand. It's not something they can afford, so you're misaligned.
It's not even something they expect.
Completely not expected.
Right.
So you got to make sure that the product that you're offering is compatible with the market you're offering it to. So you never over improve. But the best part of it is that it's incremental, meaning that the tenants expect a rental increase, right? Every year they expect their rents to usually modulate a little bit, $10, $5, $100, somewhere in there, depending on your market, is what they will expect as far as a rental growth.
That's normal. Sure.
So you're going to be able to press your rents up. And then when you deal with multifamily, you're dealing with it across all of the units that you have. So from an annualized basis, you're going to be able to impact your income with the stroke of a simple pen. Now, the other part of it is that because you're competing and you're not typically in the beginning competing at those most luxurious levels.
Sure.
It's workforce housing, it's low income housing, it's blue collar housing. That's where most people break in. What you're dealing with is clean, comfortable, safe, affordable.
Yeah.
Right? Those are your four corners of profitability. So if I can clean it up, curb appeal first,
Yep.
common areas, right? So when I walk in, make sure it smells good, guys. Smells actually more important than visuals. Okay?
You know, I was just looking at a property. We walked in.
Yeah.
Smelled bad. Place looked great.
Nope.
Smelled bad. No thanks. It smelled like chemicals covering must.
What people don't understand, exactly. What people don't understand is that your olfactory senses are most closely linked to memory. If you walk in and you smell grandma's cookies baking, it takes you to the moment.
Yep.
Right? You know, you can have the same paint on the walls. That's not going to trigger you, right? You know, it might be the same neighborhood. There's things like that. But the idea is clean. So it's got to look good. It's got to look fresh. You can't have any, you know, sludge in the corners. You can't have stains in the toilets. You can't have, you know, just a ratty,
outlines of bodies that have recently been moved.
Recently been moved chalk outlines, right? All
Can't
that
have
stuff's got to, and it's not just the interior of the suites. It's the whole journey. It's like, you know, think Goodfellas when they're walking through the restaurant down the back way. All of it's got to be
choreographed,
consistent.
Yeah.
Right. So when I walk out of the property, it's got to look clean, manicured, lawns, landscaping, lighting, signage. Real easy, right? You got to make sure that no dead cars, no rotting cars in the parking lot. You got to make sure that the parking lot looks pretty decent. If you do those things, chances are good, right? And if you have enough units, you should always have a model unit, right? That you stage with some furniture so people can start to imagine and manage their expectations about what can fit.
Yep.
Right? So you do those things. Wow, this place looks really good. Now, it might not look as good with their furniture, but it's something for them to aspire to.
That's right.
So if it's clean, first. Safe, well, that's the holy grail.
Yep.
Because now what you've done is you've opened yourself up to old ladies, single women.
Very weak men.
Well, I won't say that,
I'm
but
sorry.
you know, but guys who don't, you know, they don't carry. They're not packing heat, right? If it's not safe, you're not going there.
Sure.
And that's first and foremost, right? So in any place that you get to, you can maybe clean up your particular property, but you can't clean up a whole neighborhood. So we always run a spot crime. I'll run a spot crime report. It's free. You can get it. It'll tell you burglaries. It'll tell you, you know, assaults, robberies, all kinds of nonsense about what goes on in the area. If your spot crime isn't clean, you know, you might want to get the hell out of there, okay? The next thing that you want to do is it's got to be appropriately priced. It's got to be affordable. So you don't over improve, right? You know, I can't have, you know, dog walkers again for middle or low income, right? So you've got to make sure that it's appropriately priced, which means you're competing. I got to be cleaner, safer, and more affordable than the guy or gal I'm competing against. And if I do that, then the likelihood that I'm going to fill up and I'm going to stay stabilized occupancy, 85% occupied or above, is almost assured. And when I have that type of consistent income stream, once you season it, meaning you've got 12 consecutive months in one calendar year that shows that you're over 85% occupied, you can go to any bank in America and pretty much get a loan at about a 75% LTV. Now,
it's a pretty safe asset class.
well, not only is it a safe asset class because you're going to continue to compete, right? You're going to somebody moves out, you're going to keep it clean. Somebody moves out, you're going to only rent to somebody who looks like they have a good background, right? You got to do your background checks. But once you do that, when you get that money out of that property, and on my first deal, 24-unit apartment building, I was able to create about $850,000 in profit within 18 months of ownership. And it changed my life forever. And I did that by borrowing against the property. So I got $848,000 cash in my bank, tax-free, because it was a loan. It had to be paid back by my tenants. So the leverage that you get with apartments is the best leverage on the block.
Yeah.
And again, it's the most straightforward. So those are the reasons why I like the profitability. On a profitability scale with multifamily, especially if you buy it right, because you got to buy it right going in, I'm going to put it on a scale of 9 out of 10.
9. That's strong.
It is, because what's happening is consistently you're not going to experience extraordinary vacancy.
Okay.
Right? If you're losing a couple of tenants, you're doing something wrong. You're overpriced.
Gotcha.
You know, the
I
units
see
aren't
what you
looking
mean.
good, so you can pick it up. In the other categories, if you lose a tenant, it could take you years to replace them.
Big problem.
And it could cost a lot of money to turn that unit over.
All right. So let's talk about the risk. Where do you rate apartments or multifamily on the risk scale?
The risk scale for me on multifamily has to do with your fixed income.
Okay.
So you're only getting a fixed amount per month.
Yep.
And that contract is fixed for the year. So if all of a sudden you have a huge spike in, let's say, utility costs or a huge spike in insurance costs, which a lot of folks experienced in Florida after, 2 hurricanes, slamming into the coast, one right after the other. All of a sudden insurance went crazy. People couldn't debt coverage anymore because their rates went up like 300%.
Oof.
And it's not this extraordinary expense, but it was enough that it really started to dent their income. And if you buy at too low of a cap rate, meaning you overpaid for what you were getting, and you expected to be able to manage those expenses, the risk factor is it's real easy to bullshit people on your operating statements within apartments.
Yep.
Right? They're going to fudge those numbers like crazy. And are you ever really going to know if unit 202 was rented 16 months ago?
Probably not.
No flipping way.
Yeah.
It's not a thing. So you kind of have to take
They
them.
can give you a fake contract. You go find the person. You're not going to do that.
No one's going to do that.
No one's going to do
No. In fact, you don't even usually go through every one of the units when you're doing your due diligence.
Yeah.
So the risk factor is they fudge the numbers. The numbers are easy to fudge because it's not this, grandiose lease with a corporation that you can, go back and check the record on.
Yep. So what do you give it? 1 to 10?
Risk factor?
Yeah.
If you do your due diligence the right way, the way that we teach it, and again, ladies and gentlemen, I'm not trying to overly promote this, but if you haven't gone through the Commercial Hub or gone to our complete apartment investing program, you're missing out because it's going to give you everything that you need to avoid these problems. If you do it the right way, I would say the risk factor in multifamily, as long as you can hold it, right? You can't get in on a bridge loan with variable rates, hoping you're going to press values up and you got to be out and profit in 18 months. If you can hold it, I would say the risk factor on multifamily is a 3.
All right. So I'm going to give it a 7 inverse. So there we go.
Cool.
So, all right. And then competition. Is there a lot of competition for multifamily properties?
Tons of competition.
So,
and you got to be able to be willing to compete, just like in any business. It always drives me crazy when people try and get you to not compete. They're like, oh, there's so much competition in my market. Well, then what are you doing?
Yeah.
If you can't compete, if you can't put out a quality product for a good price and you don't want to do it consistently, then you're in the wrong game.
Yeah.
And there are plenty of other asset classes that you can get into that are not commodity based, where you sign one lease and you never have to look at the property again for 5 years. But in this business, it's a little more management intensive, right? So you got that part of it. But if you're willing to compete, you should do it. We're looking at 2,700 units in Florida right now. Class A, beautiful stuff. They're losing it. They're defaulting on it. And, and I started with 24 units, as you know.
yeah. So,
And that's just on one asset. So if I were to say, ultimately,
10 being the least competitive, 1 being the most competitive.
10,
Okay. Least competition there.
most competition.
Oh, most competition. So that's a 1.
Okay.
That's a 1. All right.
Yeah. You're going to have to fight for them.
You're going to have to fight for them. So we have a total score of, on our completely scientific and industry approved scoring system, we have a score of 17 for multifamily.
All right. So 10's the best, 1's the worst.
So for profitability, 10's the best.
Yep.
For risk, 10 is the lowest risk, 1 is the most risk.
Yep.
And for competition, 1 is the most competition, 10 is the least.
Okay.
All right.
I like it.
All right. Retail properties. What do you know about it? You ever do one? 1 or 2, 3 or 4,
Yes.
5 or 6?
That's my favorite asset class.
Not 1, not 2,
not 3, not 4,
not 5, not 6.
That didn't age well.
What did they win? One.
The Heatles, I think they won one in a strike shortened season,
Yeah.
and they won another one,
Yes.
and then they blew it up.
Yeah.
Yeah, because
Because that, as one does.
you would, right?
All right. Let's talk about the profitability of retail, and I know that's something that you're pretty passionate about.
So in retail, what you're dealing with is very geographically specific, right?
Mm-hmm.
If you're doing retail and you're on, let's say, I don't know, let's say you're on Fifth Avenue,
Okay.
right? You're on Fifth Avenue, you're gonna pay crazy rent. It's so expensive there, right? It's tough.
Right.
If you're in a tertiary market, right, it could look good, but it's hard to get tenants if there's not a lot of market to serve. So
Yep.
take a look at your marketplace that you're serving, the density, rooftops, traffic counts, those types of things. All this information is wild.
I mean, it has to make sense for the place where it's at. You're not
It
going to
really
expect.
does.
You're not going to expect Fifth Avenue rents on Main Street in Wisconsin.
And so it depends on whether you're dealing with, a retail, neighborhood retail, where it's like, the 2,000 square foot tenants in an 8,000 square foot neighborhood center versus, let's say a regional power center, or God forbid at this stage of the game, an interior corridor, dinosaur type mall.
Yeah.
Those things are dead. Stay away. Don't even think about touching them. I don't care if they give it to you for free. You will lose money. Don't do it. No interior corridor malls. The streets are lined with the bodies of people who thought they could turn those things around.
That was the chalk lines in the apartments.
Those are the chalk lines of the people who were in the low income apartments.
That's right. Yeah, that's right.
Because they lost all their money and they gave it all away.
That's right.
But your neighborhood centers, your regional centers, those things are great. I love small pad site developments. We call it small format retail. There's your gas stations, your fast food location, your bank, your urgent care,
your standalone like mobile places,
anything.
Yeah.
Your little regional, your neighborhood ice cream shop.
Yeah, all those.
All of them, right? Yep. They all work. And depending on how densely packed your market is, you could be driving down a street in Los Angeles and pass 70 of them. Right? You pass 70 little regional centers where you got.
You ever see one of those? You ever drive through Houston?
Oh my God! If they're everywhere.
Houston is just one big strip center.
It's just urban sprawl everywhere.
Yeah, it's crazy.
Everywhere.
Texas is like that in general.
But it's also a market you can be very successful.
Of course.
We're very bullish on Florida and doing a lot in Central Florida. We love Central Florida, right? Because I got 50 million, 100 million people coming there a year who aren't from there. They're going to be happy to eat at Olive Garden. They're going to be thrilled to go to Walgreens. They're going to be, so overjoyed if they can, conveniently get their eyeglasses fixed while they're broken on vacation. Right. So I know I got all this influx of folks. So now it's just about strategy and tenant mix. But when it comes down to retail from a profitability perspective, for me, it's a little delayed gratification. Retail isn't something where you're going to step in and you're going to instantly create value unless you have a tenant in tow. If you're already working with a tenant,
and you're paying for that though. I mean, if you're buying a retail center or a retail development that's already cash flowing, you're going to pay for it like it's already cash flowing.
Absolutely.
That's the
no
downside.
Doubt. And you don't pay for non-performance. So let's say you got in this scenario, let's say you got a 30,000 square foot retail center, and let's say it's 65% occupied. The anchor tenant's gone and you have one inline space that's missing. On something like that, if you know that you can backfill one of those tenants, you can pay a little more for the vacancy. In general, we pay value based on in-place income, especially in retail.
Yeah.
Because there are so many costs, broker's fees, your tenant improvement allowance, the build out for their space. No two build outs are the same. I mean, it could be a great box and you could have a lot of tenants that want to use it. But if one of them is a shoe store and let's say that the other one is a restaurant, the cost of construction
wildly different.
Is going to be so varied ends of the spectrum. It's ridiculous. So you've got to pay attention to who you think is going to be the end user. Now, for us, what I love about it is the leases are long-term.
Yeah.
Most deals will be 10, 15, 20 years. So
every business goes into it, but every expectation that they're going to be successful and be in this location because they're coming to you saying, I want to put a flag right here because I think my business is going to thrive. So they're incentivized. Right?
Well, it depends on whether it's mom and pops or whether it's like a regional operator,
sure.
Or whether it's a multi-state operator or a national operator. The higher you go up that food chain, if you will, national credit, global credit tenants, really sophisticated negotiations. And they're going to push you to the limit, and they know what those limits are. They know where it's still worth it to have them versus not. When you start dealing with mom and pops, they think that their location is what made them, usually. And so they're going to fight tooth and nail to stay there because if you're used to picking up your egg foo young right at the end of the strip center, and all of a sudden the egg foo young's gone, now all of a sudden, it's like, oh, well, I guess I got to find the other Chinese joint. And they don't want that.
You ever see a restaurant local that's relocated that ever was what it used to be?
No, almost never.
It never works.
It rarely works. Yeah. Our Manhattan Deli did it in Willoughby Hills. They left a plaza I actually owned and went somewhere else. We tried to get them back and they wouldn't come back, which kind of sucks because we could use them. So if you're watching, come on back. So here's the bottom line. Once you invest in that space, as long as you can validate the tenant's credit worthiness, now you got the income stream. That income stream could go on for 5, 7, 10, 15 years, but you can immediately capitalize it. So with it, we're talking about with multifamily apartments, mobile home parks, those types of things, you got to season it. I need 12 months of clean operating statement. I got to prove where it's at, and then it's financeable. But in retail, the second the ink is dry on that lease, if the credit is worthy, man, they're ready to pay.
That's it. All right. So profitability index here, 1 to 10.
Sophisticated operators, probably I would say 10. If you're a newbie on this one, I'm going to call it a 7.
Okay, so we're gonna slant towards 7 on this because we're gonna go for
Folks who are just
breaking in.
For sure, makes sense.
The risk on this though, 1 being the most risky, 10 being the least.
Location, baby.
Yep.
You know, great location, good traffic count, right neighborhood, buy it the right way, man. I would say risk on something like that is 1.
Okay.
Okay. However, poorly located facilities can be vacant indefinitely and never come back.
That's right.
So they can give it to you and you still can't turn it around. So the idea is, I would say, let's say a blended risk rate, 10 being the riskiest, right? 1 being the least risky, or the other way around?
10
is
being
the best. Least risk.
Least risk, yeah.
I would say retail risk is probably 6.
Okay. Competition for those retail deals. 3. Not much competition.
Not much competition. Yeah. You know what you're doing. Retail right now has been a non-favored asset class for years.
Since the internet.
Yeah, really since about 2010. People have been predicting the death of brick and mortar. And what you've got now is it's migrated. It isn't brick and mortar and it isn't clickbait. It's click and mortar. You need them both.
Click and mortar, that's clever.
People got to find it online, and then they want instant gratification. If I can click on it today and have it delivered to my house right now, the only way that works is if I have a physical location in proximity.
Or pick it up from the store right now.
I can go right to the store, pick it up in an hour.
I say, is it available at my store? And if it's not, I look at a different store. I'll drive 20 extra miles
to get it now,
instead of waiting an extra.
Right. So click and mortar is that's the marriage that's emerged out of that, and it's doing quite well.
I like
that. And
that.
because there hasn't been a ton of new development, what you're finding is that the well-located stuff, even though it's old, can be, regentrified, put back into service, and really ramp up value. In fact, I've just wrapped up. We just did a walkthrough today with a really prominent tenant. They're blowing up all over the country, called Five Below.
Yep.
And the kids love them, and everybody
kids
really
love
digging
Five
them.
Below so much.
They do a great job. And we put them into a center that I bought for $600,000. Without letting the cat out of the bag, the value of their lease alone, and they're the smallest tenant in a 6-tenant lineup, the value of their lease alone is almost $5 million. So it took some time to get them lined up. It was not a cheap build, but I mean, $5 million out of a $600,000 center for one tenant, and the value of the total facility bought for $600,000.
Do they negotiate to try to get it at like 4.8 million?
Well, they do. They push you around, and you have to spend money.
They want to be Five Below, right?
They want to be below 5.
Yeah.
Right.
Is that how it works?
Sort of.
Yeah.
Sort of. But in the end, you're able to take something that was well located on a hard corner, carve it up, create out parcels. Now that's a bigger deal, no doubt.
Sure.
But you could just do one of those beat up old out parcels, because those things were left for dead for decades.
Oh yeah.
For decades.
Oh yeah.
And we went in and we had a vision and we put something together. Now it takes time. It can't be the only thing you do. But you can take something worth 600,000, and we've done it multiple times.
Yep.
Many times, in fact. And it'll appraise around 27 million.
Yeah. Well, I mean, and look, a lot of these retail centers, they're going to still be in, areas go through 20-year cycles. Yeah. People will move out, people will move back in, young families get older, move out, young families move back in because they're affordable. And a lot of these things move cyclically, that 20-year cycle. So these older retail centers, a lot of them are coming back because now they're around older houses that are affordable. Young families are moving in and they need this. So again, if you're interested in these types of concepts, what I want you to get to the commercial hub, and we have 2 programs that'll speak specifically to retail. One of them is called retail strip mining. This is small format stuff, neighborhood centers. It'll talk about the other stuff, but it really helps you break into the game, get in light, lease options, those kind of cool strategies, let you get in light, create real value, but not take a lot of risk, all the way up to what our one of our more recent courses. I taught it for 4 days. It's unbelievable, completely changes the paradigm. It's called Renaissance in Retail. And as I've said before, retail is my personal favorite category. I love it. I don't know why. I just always have, because the data is awesome. Yeah.
Right. You just know if the people around you are making certain income, and there's so many of them, they drive by at this pace.
It's a formula.
it works.
It's formulaic.
It works. And the retailers know those formulas as well. And the best part about it is in today's marketplace, that information is available at your fingertips, in your jammies.
With AI too.
Unbelievable.
A lot of these data companies are going to be chalk outlines in the CD apartment pretty soon as well.
For sure they are.
Yep.
For sure they are.
All right, let's move on to office. Now, office is probably, I think you're going to have I think there's a lot of, office has probably experienced the most change in the last 5 years. Would that be accurate?
I would say over the last 30 years.
30 years?
Yeah, you've really seen a tremendous change. And that change had been coming for quite a while.
I mean, office buildings used to be the premier of the premier asset to own, right? I own big office
especially in the central business
Yeah.
district. If you could own a high-rise office building in downtown Manhattan,
San
San
Francisco,
Francisco, Los Angeles, Boston, Washington, D.C., Miami, you were top of the mountain.
You put your name on that building and
Top of the mountain,
Yeah.
no doubt about it. Today, very, very strong, very, 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 very challenging.
Yeah.
They struggle. The expenses are very difficult to offset. Tenants know that they're in control, which means that they really drive the hardest of bargains. It's not location specific. So where, let's say Dunkin' Donuts needs to be on the breakfast side of the street, on the way to work, they need to be within a certain traffic count, and they need to have a certain income level that they like.
Yep.
You get none of that in office. In
Yeah.
office,
Hey, this is where we work. Show up.
well, and you're making this big specific build out for these folks, and they might, $100 a foot to build out their space, and you get a 5 or 7 or a 10-year deal. And a lot. So I'm going to tell you what, profitability in office right now, even if you get the building at what you think is an unbelievable value, it is still not a guarantee. Suburban office is a little better than central business district right now. Central business district competition is just, it's out there. There's money to be made. You'd be buying at the bottom of the market, but you're going to have to be willing to hold on to it for a long time and potentially be willing to convert it. So if you want to talk about profitability right now in office, I would put it at about a 3.
Ooh, ouch.
Yeah, not good. It's not
Not
what I
great.
want you to
Not
be.
great. Now the risk. The most risk being 1?
Yeah, it's a 1.
It's a 1.
There's no doubt about it.
Yep. And the competition?
Competition is
Probably pretty light.
almost non-existent. If you want it, you can get it.
So 10.
10.
All right. I'll share the scores at the end. But a clear pattern's emerging here.
I see so. Don't cheat. Don't look.
cheat.
Don't look. Don't look at my homework.
Look. Okay. Now here's something that for a long time I think was, even in talking to your students, was always kind of viewed as a lesser than, right, category, something that was not very interesting to people. And that's industrial properties. That seems to have changed quite a bit.
Well, it has. It's changed massively. And it really started changing when we went more to an America First type policy, where we weren't offshoring all of our manufacturing, our production, all of our sourcing, our jobs. The idea, it's really kind of crazy that you could convince a citizenry to give up their livelihood so that they could buy something from a company for a few dollars or a few pennies less because they've got cheap labor overseas. And that was the erosion of that marketplace. And that really started happening back in the early 70s.
I was watching Price is Right, reruns of The Price is Right from like 1983. Bob Barker still had dark hair. And they're saying, okay, what do you think for the Showcase Showdown? What do you think the price of this new TV is? It's, like a big old box TV, 44-inch color RCI TV.
$1,000.
It was more than you pay now.
Oh yeah, sure.
All your appliances, all these kind of longer life cycle goods are more expensive 1982, 83, 84 on this show than they are right now.
Yeah.
But cost of living, cost of insurance, all the other kind of more erosionary costs are way up. So, I mean, you can buy a cheap TV, but what was the trade-off? Terrible, right? Bad trade-off. Bad trade-off for America.
And here's the real reason why it was bad. It was because our means of production eroded what was probably 75 to 80% of the gainful employment of the middle class in America. So when that went away, what you had all these old, antiquated facilities that were sitting out there, and they are not able to compete. Yeah. There was a story about America competing with Japan in the 80s and how we couldn't.
Yeah, isn't that the premise of that Michael Keaton movie?
Gung Ho, yes.
Gung Ho.
Yes,
It's a
it
great
was,
movie.
right?
I love that movie.
And the reason why we couldn't compete was because we had 70-year-old manufacturing facilities and they had brand new state-of-the-art.
That's right.
That's where we're at today. So today, America is building state-of-the-art manufacturing facilities. We're building state-of-the-art industrial distribution.
That makes sense for the things we're building now.
The things we're building now, it's crazy.
Yeah.
And so industrial ended up being a great category. So from a profitability standpoint, I would tell you it's still not too late, but you've missed most of the party. Right?
But there's small format industrial too. We're not talking about going and buying U.S. Steel's property. I mean, there's small, light industrial.
Well, and
stuff like that.
that's the differentiator. The differentiator is historically industrial would have been, massive scale, single tenant facilities.
30,000 square foot.
No, 300,000 square
Okay.
foot, right? So crazy square footages on 40 acres with infrastructure near water, near rail, near highways. That's not the model we're talking about today. Now, it's not that that's not out there. It is out there.
Sure.
But what you're dealing with there is that's all the new product. So there has been, we're talking about tens of millions of square feet of industrial being delivered every quarter.
Yep.
Every quarter. You haven't seen that in the other categories in years, okay? And it's all coming now. So what happened is people were able to get into older industrial facilities and they could get them cheap because traditionally, because they weren't hot in any capacity other than if they were logistics within the last 10 years, right? Logistically well located, the right ceiling height, the right sidewalls, the right
They
accessibility.
become distribution centers.
Yeah, right. With those things, they worked. But in the older industrial stuff, it kind of worked. But what really got hot was what is called small bay industrial, where you've got your little, you got your contractor. He's running his paint shop out of there. He's fixing your car. He's changing your oil. He's, maybe building your cabinets.
Your
right?
landscaper stores his stuff in there and runs the business out of there.
Right.
Yep.
And so they're paying you a couple $1,000s a month, and it's not really a per square foot sort of deal.
Yep.
It's almost like an apartment deal, but in commercial.
Your window tinters, painters, your tradesmen.
You name it.
Tradesmen.
Absolutely. Tradesmen, odd jobbers, that kind of stuff. They just need a place that isn't their garage for them to park their van, for their guys to show up in the morning, get their equipment, get their tools, and go to the job site.
Even e-commerce distribution. So you'll have people who have small brands, whether it's they're selling,
For sure.
they're selling,
They're reselling.
They're selling hats, they're reselling whatever.
Yep.
They need 2,000 to 4,000 square feet. They run a little business out of there.
They love it.
They don't run it out of a retail because they don't have foot traffic.
Well, they don't need the foot traffic.
Yeah.
They're not looking for something that's larger scale. It needs to be bite sized. And so those tend to be, shorter term leases and tend to do quite well.
Yep.
So from a profitability perspective, if you're in smaller format industrial, I'll put you right there at a 9.
Okay.
Very profitable. You got to find something good. You got to compete. It's got to be clean. It's got to be secure, good lighting, maybe some fencing, some security, something like that. But you can usually press those rents up. Now it's getting harder now to do that.
Okay.
You can also convert them from what used to be gross leases into triple net leases, which means that the tenant, even though let's say they are only occupying one space, they'll offset the cost of, let's say, landscaping, snowplow, maintenance, repairs, lighting, security, etc.
Yep.
So your common area maintenance. When you get into the larger format stuff, just make sure you can compete. And I can tell you if it's old, if it's built in the 1980s or before, you're starting to deal with something that's old. But a lot of this industrial stuff is built in the 30s, 40s, 50s, like real old, real garbage, right? Just be careful because that stuff's hard to compete. It's
On something that size, you want to have the tenant before you have the deal closed. I mean, if at all possible.
so many people think that their price per pound is what's going to save them, and it's not.
Yeah.
Because again, there's so much new product. And
I got
again,
$1 per square foot. That's expensive.
It is. Oh yeah. I mean, in industrial, I'm talking about serious deals, hundreds of thousands of square feet, $3,
Yeah.
$4, because they're spending so much on the space. Now, you're gonna have all the stories out there. People telling you, well, we're getting 10, 12, $15 a foot. That's on the small format stuff. It's not on the big stuff. So from a risk perspective, if it's the right asset class, right now you got to really compete. You got to really compete, and they're not terribly expensive to build, but they still do cost. So from a risk factor, I'm going to put it right around a 1 being the riskiest, 10 being the least risky. I'm going to put it at about a 4 right now, just because when we get to competition on this right now is probably 10.
The most competition.
There's so much
So
competition.
that's a 1.
Yeah.
We're going to put that at a 1.
Yeah, I get my scoring back.
Yeah, that's all right. That's what I'm here for.
That's
I have no expertise. I don't have the war stories or the amazing track record, but I can't keep score.
You can keep scoring.
And that's what
Good
I'm here for.
scorekeeper. I like it.
All right. 2 left.
Yeah.
All right. And this one, I think a lot of people ask about this because they feel like it's an easy thing to get into, and that is storage properties.
Yeah, for sure.
And now it seems almost like to me a subset of industrial, but I think it is very different because of the way it operates.
So it's more like warehouse.
Yeah.
Right.
Let's call it warehouse and storage.
Yeah, warehouse and storage. So when you get into that, that's a little different, right? So warehouse and storage is, it's kind of bulk storage. What we're talking about here usually is mini storage or self storage.
Yes, that's
so when you start getting into those types of things, because we can do industrial storage too.
Sure.
And industrial storage is a whole different ballgame. We're not talking about that today.
Yeah.
When it talks about self storage, what you're really dealing with then is demand. You take a look at different reports that you can get that say, well, there's so many square feet for each individual that lives within a certain radius of this.
Okay, makes sense.
And so they can anticipate how much demand is going to be required. And then you take a look at what's new, kind of what's middle-aged and what's old, right? And so you take a look at those because today these things can almost be fully operated through kiosk software.
Yeah.
Right. Security cameras. You don't have that person at the desk all the time. People are going to be able to access it through their phones, key cards. Your software is going to automatically bill if it's not timely. You can lock it down real quick. If they don't pay it within 60 to 90 days, you can take their stuff off. You can have an on-site auction, sell all their stuff off and get paid. What I would tell you right now, profitability in storage is down a little bit because it was such a hot category for the last 7-8 years. So hot. So profitability right now, I'd probably say is about 7.5.
Okay.
From a risk perspective, again, you can't overpay. If you're smart about how you acquire and if you're buying value add, I think you can still win. If you're getting something that's new and you think you can compete and you're not overpaying, I would tell you that your risk is probably relatively low if you're not oversaturated.
Mm-hmm.
So put your risk maybe at a
1 being the least risky.
Yeah, probably about a 3.
I'm sorry, 1 being the most risky.
Okay, so then put it at a 7.
Yep.
Flip it. And then when you talk about competition again, it's hot and heavy. I would say competition out there is probably 9.5.
Very, very much competition.
Very heavy competition. And what's happening is people are, it's Google AdWords. It's out there in every possible venue.
Yeah. And I think one thing I've heard you say a lot is that with mini storage, self storage, it's not as much of a real estate play as it is almost a business play as well.
Well,
because it's not rent in as much as it's the operations too, right? It's kind of a hybrid.
It's a bit of a hybrid. You're going to capitalize the value for sure. So it runs like real estate, as far as that's concerned. But it's month to month typically. You're not getting 10-year deals. So it's month to month. You got a heavy turnover, not a lot of expenses, not heavy maintenance for sure.
Right.
Unless you're dealing in climate controlled. If you're dealing in climate controlled, now there's a little more maintenance, there's a little more money in it too, but there's a little more infrastructure cost to maintain. So we talk about those types of things. And again, if you're interested in this kind of thing, we talk about these things even more effectively through the Commercial Academy at our live events. So click on the link below and see if you got an upcoming live event that's going to be near you. Even if it's not near you, it's only a plane ride. We do East Coast, West Coast. We do one a quarter. Get to a live event. I mean, we have hundreds and hundreds of millions of dollars worth of self-storage in portfolio with people who are at our mastermind at our quarterly meetups. So if you're interested in that category, that's probably the best place to learn it.
Yeah, you got some real storage barons in there.
Crazy.
And they've done great.
They've done fantastic,
All right, last one.
Yeah.
Before we reveal the scoring here.
Yeah.
So now before we get into the last one, make sure you click like and subscribe if you're watching this. If you enjoy this, that way anytime there's a new video from Huge Profits or from Scott, you're going to get that delivered right to you. And for all the courses and all these lessons that Scott's mentioned, go to commercialacademy.com. There you can find every course that Scott and Commercial Academy offers and all the different live events and ways that you can engage and get this education directly from the man.
Appreciate that.
Land.
Land
man.
Love land, man.
Love land, man.
Here's the thing. The old saying about land is they ain't making any more of it. And that's true.
I don't know. I just saw a map of Boston from colonial times to now.
Yeah.
And I think about something like 60% of the land of Boston has been created since colonial times.
They do the fill.
They do the fill.
Incredibly expensive.
It's a godless place because God did not create that land.
That was godless, but it's more man-made.
There you go.
All right.
All right.
I don't want to
I don't want to get into the theology of Boston.
We could, but let's not now. So here's the thing. Not all land is created equal. It depends on what the use is,
Okay.
right? So we can go everything from right of ways, which you don't even take title to.
Okay.
You don't have the deed. I have right of ways for energy. I have right of ways for utility. And I own the right of ways, which means I can literally transport whatever I need through this. And that was built for things like railways or for energy infrastructure or oil pipelines, things of that nature, right? Data lines now. So that's one type of land. But you
Don't sleep on that on data lines though, because with
No.
with data centers, with all the new fiber that they're laying all over this country to support the continued growth of technology and
AI
AI,
and revolution for sure.
that's I don't want people to miss that point that you just made. Is getting those right of ways on those types of things could be a enormously low risk, high profit thing.
It really can be. And we're gonna do a special session on data centers later this year. Really excited to talk to you about that. We're working on them in 4 different states. It's probably the hottest
It's so
bastion
hot
of
right
commercial
now.
real estate.
Yep.
And when I talk with my lenders, hey, oh yeah, we got this retail deal, we got this office deal, oh, we got this land deal. It's all great. When I say data centers, I mean their heads just explode. It's like the hottest thing. They can get it sold to almost every lender. Cap rates are low. Now there's a lot of, let's call it entitlement. There's a lot of upfront expense, but if you get one,
A lot of pushback.
this is where it's, hey, yeah, certain communities
Yeah,
are
a lot of
barking back.
pushback. Yep.
It's mostly fear mongering. They just don't understand what it's going to bring or deliver to them, and they don't want all of this infrastructure, energy buzzing and whirring around where their kids play
Yep.
baseball. But the reality of it is it's necessary, and the more local it is, the better the results and the service that you get. So you want the data centers close.
Sure.
Now, when it comes to land plays, though, you can go from anything from right-of-ways to agricultural. We do agricultural work. We do all kinds of farming. We do sharecropping, right? So we can let other people run the land, and we just reap the harvest.
Which is a great way to sit on land that you can maybe anticipate being in the line of
Path of
progress, yeah.
Path of progress. So those are what we call covered land plays, where you can generate some revenue while the progress is moving towards you.
I
The
like
land's
that one
raising
a
in
lot.
value.
I like that idea a lot.
The other thing is that you've got the opportunity to do adaptive reuse of land, right? So it used to be for this, but now we're going to change it. So you see, one of the more famous ones is old mobile home parks or golf courses turning into housing subdivisions. They
Yep.
made money, selling, cart fees,
Yep.
right? And around a golf. And today they can carve it up into 200 houses, and they can make a ton of money, and it's beautiful, and it's got all sorts of topography, and it's got mature trees and woodlands, and they can put little green spaces in there, and those are really valuable. Then you can get down to land that's well located, right? So you got land that's well located. So it's, hey, there's already traffic around it, there's already people here, and we can turn that into something. Okay, so that's great. Then you've got land that can be entitled. What could it be? And I don't even have to be the one that brings it, but if I give somebody the right to use it here, I've added a lot of value.
Sure.
And then last but certainly not least, at least for this discussion, you can deal with what I love, which are these pad sites, small format retail. If you drive by something and it's been vacant for a long time or it's underutilized, make the phone call.
Yeah, let's include demolition in land, because what you're doing is you're scraping it and
Yeah, you
delivering
can
a fresh
scrape
pad.
it. And in a lot of instances, you're dealing with a piece of land that may have been vacant since God created it.
Yep.
Right? Or man created it.
Or
if
man
you're in
created it.
Boston.
Yep.
Right? So at the end of the day, I love land. What I find is that you can more easily control it. So you can get in with lease options, so you can get in light. If you start to understand what the user's criteria are, you can start to bird dog land sites. And if the site meets the criteria, you can have that tenant in tow before you close. And so it's one of the reasons why I like land. Now, from a profitability perspective, obviously you can create massive amounts of value, but it typically takes time.
Yeah.
So from a profitability perspective, short term, I would put it at maybe a 5,
Okay.
right? From a, let's call it a risk perspective, it's probably, if it's not performing now, that's about as risky as it gets, because you got to turn it into something. So unless you've got some
Although
user,
the carrying costs are typically crazy for most land, is it?
no, but here's what I'll tell you is, it usually costs a lot of money to make it perform,
Okay.
right? So from a risk
I
perspective,
see
to
what you
make
mean.
it do
Get it
something,
deliverable.
I would say you're probably, you're on the higher end of risk. So
Okay.
probably a 2 or 3.
All right.
And then when it comes down to competition, it depends on the land, of course, right? If it's right next to the brand new stadium that they're building, or, there's an expansion at the airport and all of a sudden there's going to be a ton of traffic there, that's expensive land. But land in general, competition's pretty low. I'd probably put it at maybe a 3 as well.
Okay. All right. So now we have our final.
I can't wait to see how this turned out.
I know.
Pretty excited.
All right. Now this is the official Commercial Academy scoring system. All
I'm
right.
not sure that this is the official Commercial Academy scoring system.
For today it is.
Okay, but for today, I'll give it to you because we might score it a little differently. We've got some proprietary scoring even on our Commercial Hub on deals.
That's right.
That we utilize to help you. If you're not sure what you're looking at, we can help you score deals, and it'll let you at least know what our opinion of the deal would be.
Yep.
And that goes a long way. But this is, I think,
remember,
this is an off-the-cuff sort of way of handling it.
Yeah, this is arbitrary, and this is really with new investors or more early in their career investors.
Yeah,
right? Any of these things, any one of these could be a 0 or a 10 on any of these deals.
100%. It's not baked in. It's not
All
dyed
right.
in the wool.
So we'll go from the very bottom.
All right.
Your least favorable office. I don't think that was surprising.
I don't think it's surprising. And yet at the same time, what I'll tell you is if you're out there and you're looking at offices and you have opportunities, if you can get in light, you can manage your holding costs, and it's really well located, adaptive reuse possibilities, you can get in to that entitlement, that zoning, that fit plan. And more often than not on my larger office deals, I entitle them and I flip them out to a developer who wants to take it all the way to the end.
Yep.
And make millions of dollars in the process just for a paper process.
So out of a total score of 30, office got 14. Tied with that was industrial with 14.
Which is curious to me.
Yeah. But here's why.
Where did it take the hit?
Took the risk on the competition because the competition's crazy. You gave it the lowest possible score on competition.
And you know what? And that's appropriate.
Right? Now, look, it had high scores in risk and in profitability, but
the competition is fierce right now.
Absolutely nuts.
And everybody will tell you that that's the truth.
Now tied for, let's call it third place, tied for third place, warehouse storage properties coming in at 15. Right middle of the road.
And what I'll tell you about that is
competition again is what killed that one.
Yeah, because there's just a lot of people in the game because it's easy to break in.
Yep.
I love it because of the ease of management, but here's the thing, you got heavy turnover. I mean, if you have a decent sized self-storage portfolio, you're cashing more checks a month than you want to shake a stick at. And they're like $50, $80, $150. I mean, it's a lot of processing of paper for not a lot of juice. Yeah. But on the whole, you can make a lot of money with them. Just not my personal favorite.
Tied with that is land at a total of 15.
Yeah.
Now that got hit in the risk.
Yeah, and I love land because land is something, if you're not in a hurry and you're making a lot of money.
I think the risk here, so I think on the land one, the risk can go, I think the risk is more nebulous than we could put it there. So you have it at a 3.
And the reason I have it as a 3 is because typically it's a non-cash flowing asset as it sits as current vacant land or undeveloped land. And just the entitlement process alone could take you a year. And I think for new investors, the reason I call this risky is because you're not necessarily generating revenue. Now, if you've got a covered land play, then you can certainly turn that around.
Or if you can get an option on it.
And if you get an option on it, you can kind of lower and mitigate your risk. But the timeline to profitability is a little longer.
Yes.
And, unless you got that tenant in tow.
Yeah, this one has room to grow, but it's coming in at 15.
And I think they all do have the ability to modulate. But in general, if you were getting started, this is certainly how I would rank it.
I would agree.
Yeah.
Second place, retail, coming in at a total of 16.
Well, look, it lines up with what I found to be most desirable and what my clients seem to like. So here's what ends up happening. They follow this path. They start off in residential real estate and they're out there and they're hustling and they're turning them and they're competing because it's a total commodity. If somebody next to you sells cheap, you just lost value. If somebody, if somebody loses their house and the value goes down, if somebody doesn't maintain it, if somebody, if there's violence that happens on your street, all of a sudden your values hurt. So you get that. And people are out there and they're flipping and there's contractors and people are cheating you and you got all this stuff going on. You typically make a little less than you think you will, let's be honest.
Yep.
And from a scalability standpoint, by the time you've done 20 of them, you're usually pretty fatigued.
Yep.
If you've done 50 or 100 or 200, you're definitely fatigued.
You're done. You're done.
Right? And so you're going to want to get into something that has that appeal. When you get into multifamily, it's great, but it's still tenants and toilets, right? Everybody's problem becomes your problem. Hey, my dog.
You grow out of that quickly.
Well, unless you have great management, there's, I'll tell you what, a lot of people made a lot of money in multifamily, but they have to have great management. Okay. And it's oftentimes hard to third party that because they don't care the way that maybe you need to.
Yep.
And so when that happens, a lot of people start to find the appeal of signing one lease with a professional tenant where they never call you for a problem, and it's a 5, 10, 15, 20-year income stream. That's one of the reasons why people tend to like retail, and you can start so small.
Yes.
Right. So if you're driving down the street and you see a center with 5 spaces and 3 of them are vacant, that is screaming.
That's the one.
Motivated selling.
That's the one.
Right?
Yep.
So go in there, make your offer, and you can get it done. I've always liked it. I find it bite-sized. I also find that it is on that side of pure commercial real estate. So it underwrites the right way. You can compress cap rates, and there's not that much to it. You got a roof, you got a facade. So the only thing people see is the facade.
Yeah.
A little bit of paint, a little bit of blacktop, and a couple plants. Man, an old center can look real fresh.
Sure can. So you had a total of 16 on that. And then coming in at number 1, and again, keeping in mind that this is for your newer or more beginning of their career investors, you have multifamily, which I think has been your consistent message throughout your career in your education, with a total score of 17.
And that's being reinforced by what people experience, right? Yeah. It's just such that natural transition, like we talked about. You know, just a very methodical approach can yield hundreds of thousands of dollars a year in increased value. You're going to get that amortization of the debt when your tenants come together and they pay down all of your, all of your mortgages. Mm-hmm. You've got that tax shelter that you're going to get from depreciation. And then last but not least, the thing that is your real wealth stimulator is you have appreciation.
Yes.
So when all 4 of those start to work for you over the course of a few short years in time, it's a guaranteed model for creating success.
So if you like this episode and you want to give us a ranking, go, if you're listening on Spotify, make sure you give us a good ranking there. If you're watching on YouTube, make sure you click the like and subscribe button and maybe even the share button. And again, if you want to learn more about all the courses and all the different educational opportunities that Scott and the Commercial Academy offer, you go to commercialacademy.com and learn about all the different courses on Commercial Hub and the live Commercial Academy training events. Scott, I give you a 10 out of 10 on this one.
I appreciate that.
You did a good job.
Well, you brought the topic, right? You brought the scoring system. I had to kind of, navigate my way through it. But I think what happened was your scoring system was accurate in the reality that it really did expose that they're pretty close.
They really are.
They really are all pretty close. You can make any of them work, but you got to find out what category
you have a 2-point variance from your best to your worst.
Right, which is kind of how it works. And it is so so unique and so specific to the individual. That's why we find that direct interaction with people who have done it before is your greatest stimulator to creating success. Mm-hmm. And as we say oftentimes in commercial real estate and specifically at Commercial Academy, it's not a if, it's a when, as long as you don't quit. And it really does only take one deal, one time to change your life forever. I hope I get a chance to work with you. God bless. Thanks for coming.